Hello. In this video, we'll be going through the depletion of natural resources. A quick definition of natural resources is a long-term asset such as mineral deposits, oil reserves, and timber stands, and its acquisition. There are four different types of costs that are capitalized to the balance sheet. It's the acquisition, exploration, development, restoration costs. If you would like to go further into what all these costs are, there is a separate video from the previous chapter. So once those costs are capitalized on the balance sheet, right, meaning we record as a long-term asset on the balance sheet, we then have to allocate those costs over some period, and we call that depletion. Depletion is this similar to depreciation of property, plant, and equipment, and similar to the amortization of intangible assets. It's the term we use when we allocate the cost of that asset into the income statement. So the natural resources are really taken from the ground, and typically when you do depreciation, many times you have a useful life or service life. You don't have that for a natural resource. So typically for natural resource, we use an activity-based depreciation method, and that is the units of production method, which we have covered in previous videos. So what we call the service life is going to be the amount of natural resource that we expect to be extracted over the lifetime that we have that natural resource. So similar to straight line depreciation, our numerator is going to be our cost minus residual value, and that's called the depletion base. And then we're going to divide that by the estimated extractable units. And an example of that is like if we have a mineral deposit, then we can maybe estimate the tons of minerals or maybe the barrels of oil that will be extracted. And that's what these extractable units refer to. When depletion is recorded, you will debit depletion, right? And that goes on the income statement. And the credit will go directly to the capitalized asset on the balance sheet. That's why it says natural resource. But whether it's a oil and gas reserve, mineral deposits, timber, whatever it is, typically what we have seen before for depreciation is that there's an accumulated depreciation account, and you can have a accumulated depletion account, but that's not usually used. We usually just credit the actual asset. So let's go through an example. In 2027, Canyon Mining Company has the following 5 costs related to 500 acres of land in Pennsylvania. They have the payment for the right to explore the copper deposit, actual exploration costs for the copper deposit, intangible development costs in digging, and the expected cost to restore the land after extraction is completed. So we have a total cost of $2.768 million. Additionally, we also have this excavation equipment that we use in the project for $600,000. The company's geologist estimates that 1 million tons of copper will be extracted over a 3-year period. After the copper is removed from the site, the excavation equipment will be sold for an anticipated residual value of $60,000. During 2027, 300,000 tons were extracted. So first thing we do is for this cost, the $2.768 million, which is the cost of the copper deposit, calculate the depletion base, which is the cost minus residual value. In this situation, we're not told of a residual value, but oftentimes there can be significant residual value when it comes to natural resources, because if they have to restore the land after the extraction, that land can have significant value. But in this situation, it's not told, so we assume 0. So you do the depletion base divided by the number of units estimated to be extracted over the lifetime of the project. Now notice we have a 3-year period. That's irrelevant. We're just gonna irrelevant in terms of calculating the depletion per unit, which in this case are tons. It's just that we will deplete it for 3 years, and then the copper rights will be done. So we take the 2,768 divided by 1 million. We have $2.76836 per ton. We are told that in 2027, 300,000 tons were extracted. And so our journal entry is going to be the depletion per ton of $2.76 times the 300,000 tons. And we're going to debit depletion. Again, that goes on the income statement for $830,508. And we're just going to credit the actual asset that we initially capitalized, copper deposit, $830,508. Let's do a quick concept check. Crystal Corporation acquired a copper mine at a total cost of $15 million. The mine is expected to produce 30 million tons of copper over its 5-year useful life. During the first year of operations, 3 million tons of copper were extracted. What is the depletion for the first year? Well, we're going to take our depletion cost, right, our depletion base, which we're told is 15 million, divided by the estimated number of units that will be extracted over the lifetime, over its useful life, which we're told is 30 million, right? So that equals to 50 cents per ton. And during the first year of operation, 3 million tons were extracted. So you do 50 cents times 3 million equals 1.5 million. So the depletion expense that we're going to take on our income statement will be $1.5 million. Now, in the example that we just went through, there was also equipment that was used in the extraction. So how do we depreciate that equipment? Well, it depends. If that asset that we used in extraction is movable and usable, right, in the future, then you would just take the depreciable base over its useful life and start depreciating it as depreciation expense. However, if that asset is not movable and therefore you can't use it on future projects, then the asset should be depreciated over its useful life or the life of the natural resource, whichever is shorter. And units of production method is often used to determine the depreciation on assets used in the extraction of natural resources. And go through the calculation. You're going to calculate depreciation per unit using the depreciation base divided by the estimated extractable units. So back to our example where we have here the cost of $600,000 for the equipment, and it tells us the residual value is 60 million, and that we expect that 1 million tons of copper will be extracted. So the depreciation per ton is the 600,000 minus 60,000 divided by 1 million gives you 54 cents per ton. We're told in 2027, 300,000 tons were extracted. So we'll multiply that by 54 cents and we get depreciation of $162,000. This is not really the end of the calculation because going back to this slide, it's the end of the calculation, but really it's over what period do we depreciate that asset, right? Over what period do we take $162,000 of depreciation expense every year? And that time period is determined to be, it should be depreciated over the asset's useful life or the life of the natural resource. Whichever one is shorter, that's how many years you'll be taking the depreciation expense for that asset.